What's up, guys? Welcome back to another video. About the intro you just saw with Smart Prop Firm, I'm actually working very closely with them, and we've decided to do a huge giveaway for this video. We're going to be giving away thousands of dollars worth in evaluations, specifically these above my head. It's about 12 different ones ranging from 50K to 100K with firms like Tradeify, Take Profit Trader, and Lucid. All you have to do to enter is like the video, subscribe to the channel, and comment down below your biggest takeaway from this video. The winners will be selected 1 week from now. That being said, let's dive right into the topic of discussion today, which is pivot context. Now, the concept itself is a very simple lesson. Today is not going to be something crazy complex. It is something that I have to touch on because a lot of people think, just based on all my videos, that you can only trade from fair value gaps, which is not the case. There's an often overlooked level that you can trade from, which is just straight up swing points. So just like we know about context with IRO to ERO, where context is that boundary and price where we can trade from that fair value gap to that ERL. We all know IRO to ERO. You should know it by now. It's what we talk about in every single video. We can do that same exact thing. Look for a context area to trade within with just swing points right here. Where price comes into one swing point, we can now build a context area to target the opposing swing point. But why does that work, and what is the exact logic behind that? Well, in order to understand why that is how price moves, we must first understand these swing point basics and what is found at swing points. I'm going to remove my face right here, and we're going to take a look at how to identify swing point basics. It's very, very simple. I'm sure we all know how to identify it at this point, but in case you don't, I want to make sure we are all on the same exact page. A swing point is simply a 3-candle pattern with the second candle sticking out above the others. So a swing high, candle 2 is going to be above candle 1 and 3. A swing low, candle 2 is going to be below candle 1 and 3's lows. And if you were to put a baby in front of a chart and just told him to point at something, he's most likely going to point at a swing point. Just these sharp, pointy edges that just stick out on a chart. Now, swing points are important because that is where we find the beautiful concept of liquidity. Below and above swing points, we will find resting liquidity that acts as magnets for price. Now, first of all, what is liquidity? Liquidity is me. Liquidity is you. Liquidity is every single buy and sell order in the market. Now, why do we need to know this? Well, we want to be trading alongside smart money. Remember, smart money are just these big market participants, the big banks, the hedge funds, large entities, financial institutions that have all this capital to influence markets significantly. So since they have so much capital, whenever they buy and sell, they can't buy and sell like me and you buy and sell in the market, where I just click buy and I get filled immediately on my one e-mini. They have such large orders that they need to pair their buy orders with opposing sell orders, for example. So what smart money does is that if they want to buy, they are going to target below swing lows, sell side liquidity, for their buys. Why is that? Because that is where sell side liquidity rests. There is a lot of traders, majority of traders place their stop orders around swing points. And that is why smart money looks to get involved. They're taking advantage of all these traders doing the exact same thing, understanding that that is where all the liquidity is. There's a lot of orders that they compare their huge opposing orders with. So put simply, their orders are so incredibly large, they cannot just buy and sell anywhere. They need to buy at these liquidity levels. So if smart money is bullish, they're going to be buying below old swing lows. If they're bearish, they're going to be looking to sell above old swing highs. Now, where will they offload their position? The same exact thing applies. They have such large orders, they can't just buy or sell anywhere. They need to offload their positions at levels of major liquidity in order to get filled on all their orders. So they will target opposing liquidity. So if they're shorting from buy side liquidity, they will target sell side liquidity. If they're longing from sell side liquidity, they will target buy side liquidity. And now you see the context area that we are building for ourselves to trade. So let's go into the specific scenario where I actually implement this myself for high probability setups. So we must already be in a pre-established trend, having pre-established order flow. So we want to make sure we have clear direction. Are we clearly bullish? Because If we're clearly bullish, any move seen below a swing low is just seen as a stop punt to just continue pushing higher. So you want to make sure we are trending when we have an idea of what direction the market has been heading in. So over here for this example, you see right on the screen, let's say we have been in very bullish order flow. So specifically, pivot context is when price fails to create a new fair value gap off of a previous fair value gap and creates a low probability leg. Price then uses the low of that low probability leg as a new discount array to move higher from. Now let's first understand what a high probability leg is to then understand what a low probability leg is. Remember the recent order flow video where a high probability leg is simply a swing low to a swing high with a fair value gap in the middle, also being in context of the time frames above it. A low probability leg is a swing low to swing high with no fair value gap in the middle. So since there's no fair value gap in the middle, there's nowhere we can really move higher from in that leg except a swing low. That swing low is the only discount array price can really utilize to then use as a launch pad to continue pushing higher. So I'm looking for pivot context off of failed expansions off of previous fair value gaps. So over here, we have a daily fair value gap that ideally in an ideal high probability scenario, you have fair value gaps creating new fair value gaps, which when that doesn't happen, we can look to utilize pivot context. Now moving on to the second type of pivot context right here, it's no longer from a swing point to swing point. This one, we can frame it from a previous candle's low or previous candle's high to a swing point. So when the first candle closes inside a fair value gap, signaling a disrespect to that fair value gap, the previous candle's low then can create an area for price to use to move higher again. It is the new reason for an expected move higher, the new catalyst, the new launch pad. And the reason we see it this way, and the same thing we view this right here on pivot context 1, this swing low as the new catalyst for higher prices, and not just this same daily fair value gap that we were traced back into. That's the reason, is because when I view price, the moment price enters a fair value gap, I consider that fair value gap used up and mitigated. You don't know what mitigated means, that just means used up. Unmitigated means untapped, it's fresh, it's unused up. But the first moment price enters a fair value gap, I consider it mitigated, and if we don't respect it right then and there, I will keep an eye on that disrespect candles low as a potential catalyst to see a continued higher price in this bullish scenario right here. Pivot context 2 can be called a 2-candle rejection. Credit to Arjo for that one, love him. And now we're just going to go into some chart examples, but before we do, I want to let you guys know that all the YouTube PDFs that we have done in the recent videos, you can get access to all of these slides for free in the link in the description. I think they're really nice little study guides to have with you and just review some of the concepts we have been over. So check it out, link in the description for those PDFs. So here we are on our first example on the gold futures chart. We are on the weekly time frame right here. And remember what I said about pivot context in the earlier slides, where you want to be implementing it primarily in scenarios where you have a very clear trend, very clear order flow, very clear idea of where price is heading. So over here on gold, we have a very clear idea of what price is likely going to be bullish. We've been in an extremely bullish order flow right here, just reaching new all-time highs. We have a weekly fair value gap we can push higher from. So this would just simply be on a weekly basis, weekly IRL to ERL. Now, moving down the time frame, we will notice right here in this section of price action, we have a daily fair value gap that was created off of that weekly, which is great. We even completed that context right here. IRL to ERL context completed with this move. Now, what didn't happen is we didn't create a new fair value gap to push higher from. Remember, if there is no fair value gap in a leg right here, it is a low probability price leg, and what price will likely do in order to continue pushing higher is seek the low of that leg, just the swing low that was created inside of this fair value gap, to use as liquidity to continue pushing higher, using that as a launch pad to target this opposing buy side liquidity. So from sell side liquidity, price will now target buy side liquidity. So this level right here, I'll just highlight it in a little darker shade, is our area of interest if we want to continue pushing higher we want to be observing how price reacts at this level on the lower time frames to confirm that. Moving down into the hourly, which is the properly aligned time frame, going off of a daily level, I'm going to be looking for an impulse shift after price runs that low to then confirm that market maker buy model up towards this high right there. If you don't know what an impulse shift is, I have an entire video on that. It will be linked over here in the top right, so be sure to watch that. But simply said, that's how I confirm price wants to reverse off of a higher time frame PD array. So let's wait for that and let's continue moving forward in price for when that actually happens. So we take the daily swing low right there, the pivot context low, and I'm just waiting for an impulse shift above this level. I want price to prove to me that we are rejecting and sweeping that swing low. There's going to be a 1 hour for value gap right here that I would not take. This one right here, it's a bit early. There's nothing wrong with demanding more confirmation, right? When in doubt, just demand an extra for value gap. So in a scenario like this where the for value gap happens down here and we're not actually yet sweeping this, I'll do here is wait for an extra for value gap for a higher probability entry, and you can enter at the for value gap, stop loss at the swing low, and target a very simple 2R right there, and this would be your trade. So let's see how that plays out. And there right there, and just 2 candles you get filled for your 2R. Now at this moment in time, you may see another 1 hour for value gap and another 1 hour for value gap. Keep in mind, when you see a lot of expansion on one singular time frame, what that is going to be on the higher time frames above it, because all this 1 hour expansion is most likely going to create a 4 hour for value gap at some point that price might want to look at to retrace into and then continue pushing higher off of that. So you don't just want to take every single 1 hour for value gap and think we're going to go higher in this perfect world. No, zoom out and be aware of the for value gaps above you, because what we're going to do right here is go up to the 4 hour. So there is your 4 hour for value gap, and what you can do is just enter off of that, right? So you can set your order right here at that 4 hour for value gap. Stop loss can be at the swing low bodies. And by the way, if you're wondering why you can enter right here and why this is not something I'm truly considering a bag, is because we just swept a premium array, right? So what this does is it's giving a reason for price to actually want to retrace back down into here to then continue pushing higher. Had we closed above this level right here aggressively, then it's most likely we're not retracing back into that bag. But since we did sweep this high, it's not something I would consider high probability to stay open. This has a very good chance of actually getting retraced into. So you can enter your trade and it can look something like this. Now you may be wondering, but pickle, my R, my TP is way above context highs. And yes, it is. And that's unfortunate. It's not the ideal scenario. Ideally, it is within context, but there's just certain times where you can't really get that 2R within context. But that's still okay. You can still take the trade, because what you can do is once price takes this context high right there, you just go break even. And in the event it actually just sweeps, you don't lose anything. But in the event it plays out and then continues expanding, you get a nice trade. So it's fine to target above 2R if that is how your R works out with the stop loss. Just make sure to always go break even once that context high is taken, because that's the level you're reaching for. That's the draw. Once that's gone, whatever happens after that is really out of your hands. So back to this, let's just see how this one would have played out. And there's your 2R. As you can see, it was not the most beautiful delivery of all time. In fact, this was very nasty right here in terms of, you were sitting in some pretty heavy drawdown, but that's okay. That is why we have stop losses in place. We have those stops in the market, and we're going to allow them to do their job. What I really don't want you to do, and this is something that I personally struggled with a lot and really held me back and led to so many frustrations, is when a trade isn't panning out as it should or as you would have hoped it would in an ideal world, where we just project and start continue pushing higher and start creating opposing for value gaps like this. What you don't want to do is sell down right here as price is starting to near your stop loss in an effort to save a few bucks right here. No, I've had a scenario like this happen to me more times than I can remember, where I would do that, I would sell, and I would literally bottom tick the low of what would eventually be the low that made my TP get hit. And I'm sure a lot of you out there can relate to that. So a hard rule that I do and that I recommend for you is, once your orders are set, you will not manual exit. No manual exits. You let your stop loss be the only reason you get out. because the market is not perfect. The market is random. This is very possible in any trade you get into, no matter how high probability you think it is. Things like this is possible. And you don't want to undercut yourself by selling out of fear that your stop loss is going to get hit and you just give up on the trade prematurely. Let it work. Let the stops do their job. All right, so here we are on our next example, and we're on the Bitcoin weekly chart. We have been in very bullish order flow. We can just continue seeking all-time highs right here. Where can we move higher from? Because what happened right here is we had a weekly fair value gap that we came into, and yes, it's a weekly fair value gap, not a breakaway gap, because of what we just discussed in the previous video, where we already met that draw on liquidity, and now we have a reason to actually push price lower because we respected that premium rate. Whereas, for example, back here, yes, that is now a breakaway gap because now we have a draw on liquidity that price likely wants to be in a hurry to reach first, and may just be the catalyst to actually then retrace into that fair value gap right there. So we came into that weekly fair value gap and we tried to expand higher and complete this weekly IRL to Euro, but we couldn't. We couldn't create new expansions higher. And now what happened, if we move forward in time, this candle created just a low probability leg right there. So if we still want to push higher, where can it happen from? This is where pivot context comes into play. It would happen from this swing low right here created in that weekly fair value gap. So now the context area in which you want to look for trades, the boundary and price in which we are trading becomes from that swing low to that swing high. So here we are on the 4 hour. I'm just going to move along a price to when we actually take that weekly swing low, pivot context low. And now we're doing the same exact thing. We're looking for an impulse shift. This is a weekly level, so now we're looking for a 4 hour impulse shift. So we're simply looking for a fair value gap into that array and out of it. So right here, we're just going to be waiting for that. And we see it right here in price. Now that is a breakaway gap, but you can do a couple things right here. You can either just market by this bag right here and have your stop loss at the swing bodies and target a static 2R, which would be very valid in the case that you just want to get involved. You don't want to miss the trade, but you may have a further TP. That's if you want to buy the bag. Now, if you want a better RR and you're fine with missing the trade, you know, there's pros and cons to everything. You can just also have your order in that fair value gap, same exact stop loss, and just target a static 2R in the event price does want to retrace. Because even if it does retrace, it's still fine. We can still move higher off of that. All right, it's just the probabilities right here, just based on how this closed. More times than not, it tends to just leave it unfilled and continue pushing higher. At this point, this is turning into like a breakaway gap video, so I'm not going to speak any more on that. But let's just see how this plays out. All right, so over here, you would get filled on this right here. And this honestly looks like it was news inspired just based on how volatile that single candle was. So not sure what that was, but that is a gnarly move. Both of these entries right here, first of all, this one, you would have got your 2R hit right there. And if you just bought the bag, we will see if that ends up right here giving you 2R, which it does. So both entry methods would have worked. On our next example, we are now back on the gold futures chart and we have weekly context right here. We have a bullish weekly bias. Very, very simple. Moving down into the 4 hours, just a properly aligned time frame off of a weekly IRL, we will notice that we have a 4 hour fair value gap here. That did what? It failed to create new expansions and new fair value gaps to push higher. So now the level at which we will want to frame potential longs out of and use as a catalyst, launch pad to seek that high now becomes right here. This swing low formed in the fair value gap is our area of interest. So moving into the 15-minute, which is the properly aligned time frame from a 4 hour level right here, we're going to be looking for a 15-minute impulse shift. Now, this is an intraday example actually, so let's view that, how that sets up. We would want to ideally enter inside of a kill zone. So we're going to be waiting for that to happen inside this gray box, which is just the New York AM session. So now we're just waiting for an impulse shift out of that, and there it is. Let's mark that up. The indicator doing that for us beautifully. And that right there is your entry. Order flow leg right there. Your stop loss can go at the swing low bodies, and you can target a static 2R. And let's just see how this one played out. Beautiful hitting 2R, eventually completing that pivot context right here by tagging that buy side liquidity. Remember, price is always going to move from discount array to premium array. And speaking about swing highs and swing lows and pivot context, I'm so excited to announce that we are currently working on a major update for the entry alert indicator right here. in which we're going to be adding pivot context alerts. So now not only will you be alerted out of IRL rejections, 2 candle rejections, pivot context is coming and it is in the works. So for example, on gold, if you would have set those alerts, you would have received the alert to your phone, your watch, your email, wherever you want it, that this impulse shift is being created. The moment it gets created, you get the noti, you can look at your charts, save time, just take the trade, and it's beautiful. It's an absolute powerhouse of a tool alongside all the other insane powerhouses like the order flow indicator you've seen me use this entire video. So be sure to check that out. Now we're going to take a look at a couple pivot context 2 examples, also known as 2 candle rejection. Remember many ages ago when we were talking about it in the slides, how to spot them, right? It all begins with that first candle that comes into the fair value gap being a disrespect candle and just closing inside of it. That is why it is disrespecting that fair value gap. Now, if we still want to continue pushing higher, our attention will now go to that disrespect candle's low right here, just that previous candle's low. And to confirm if we actually do want to use that as a launch pad, as a catalyst to continue pushing higher, we want to dive down into our properly aligned time frame. So in this case, the 15-minute, and look for our impulse shift out of that. And in case you're wondering, because I already know what a lot of you are thinking, why am I looking at this 4-hour fair value gap as a valid reason to go higher when we have a daily fair value gap below? It is because we have this massive area of fair value right here that is acting as the first line of defense, right? And if we start respecting that and seeing rejections and seeing fair value gaps already want to push higher, it is likely that this daily fair value gap right here is going to act as a breakaway gap because it is inside of this area of fair value that we shouldn't even see a deep sting inside of anyways. And we want to already just move higher off of that. So that is why I am looking at that 4-hour fair value gap as a reason to already move higher. So diving down to the 15-minute, let's move forward in time to when we actually sweep that low. Now we're looking for our impulse shift, which we see right there. So that is your entry. Stop loss goes at the swing low that creates that. Entry at the fair value gap. And just target a static 2R, which would give you something like that. And also, if you wanted to be inside of a kill zone, when is this happening? 3:30 a.m. That is right in the middle of the London session. So this is a very great trade. And let's see how this one played out. Eventually hitting 2R and completing that 4-hour pivot context right there. And this is what the 4-hour looked like for reference. Over here on our next example, we are on the dollar weekly chart and we have a weekly fair value gap right here. And what we'll notice is this first candle that has retraced into this weekly fair value gap has closed inside it, signaling a disrespect. If we still want to push higher, we want to keep an eye on this disrespect candle's low right here and just monitor any sort of impulse shifts, reactions we are getting after we have swept that low on a 4-hour time frame, for example. So here we are on the 4-hour and we're just waiting for a clean reaction out of that sweep if we do get that. So we're going to move forward in time right here. And what you'll notice is you can see a 4-hour fair value gap get created right here. And I'll just move along so the indicator marks it real quick right there. What I don't like about that and why I personally would not trade that is because we're not seeing intention to actually push higher. We're sort of just in this little range. We didn't convincingly displace higher. This little leg right here, to me, it's not convincing. It's not aggressive enough. So in scenarios like that, I would just demand an extra leg. Remember, when in doubt, just demand more confirmation. There's nothing wrong with demanding another fair value gap if you're uncertain about a move. So over here, what I would do is I'd wait. Do we get another fair value gap? Yes, we do right here. And this is intention. This is aggressive displacement away from this pivot context low. That is beautiful. If you want, you can just look to enter in there. Obviously, you can't trade the dollar, but just trade the euro or the pound based off of this idea right here. But we'll just take a look at how dollar played out in this 4-hour gap. Eventually hitting 2R on the initial trade idea and completing the weekly 2-candle rejection right here. For the reference, this is what that would have looked like on a weekly basis. So that wraps up today's video. If you found it insightful, I would really appreciate a like, a comment, a subscription to my channel would be very sweet and kind of you. It would inspire me to start making even more videos, maybe post more frequently, so that would be really appreciated. Also, you will automatically enroll yourself in the giveaway we mentioned in the beginning of the video if you just do all that. If you like, comment your biggest takeaway from the video, and subscribe. Remember, we're giving away a ton of evaluation accounts. Winners will be selected next week. And in case you are wondering where you can get access to my custom set of indicators that you saw me use throughout this entire video, all these right here, the order flow indicator, which does all your charting for you, literally automates everything as if I was doing it for you. The navigator indicator, the risk manager, the beautiful SMT indicator, and my favorite, the entry alert indicator, so you never miss a trade again. Also as well, I mentioned that we're going to be updating that with pivot context, the exact topic we talked about in this video. We're going to be adding that to the entry alert indicator, so that is major. If you want to check them out, the link for that will be in the description. There is also a 30% off sale for your first month, so you can easily get started today. I'm in love with these tools, and I'm 100% positive that you will also love them just as much. So do check that out. That being said, much love. See you on the next one. Peace out, fam.